This is Macro Horizons, episode 279, A Season for Consolidation, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Jeffery and Vail Hartman to bring you our thoughts from the trading desk for the upcoming week of June 24th. And with the first official day of summer now behind us, we look forward to shorter days, shorter commutes, and lower yields. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had three defining events. The first was disappointment on the retail sales front. This was data for the month of May, and it came in below expectations and was accompanied by downward revisions to April, putting pressure on the departure point for consumption in the second quarter. Second, the market was closed on Wednesday, which paused the bullish momentum that followed the disappointing retail sales print, and when the market reopened on Thursday, there was a more bond bearish tone. Now, it's important to keep in mind that this bond bearishness was well contained within the prevailing range, as 10-year yields remained comfortably below 440. We also saw initial jobless claims come in higher than expected for non-farm payroll survey week. While it did represent a slight improvement from the following week, nonetheless, claims are trending higher than they have in the last 6 or 8 months. Let us not forget there was notably strong demand for the 20-year auction, which reinforced the notion that there remains a solid bid for treasuries as an asset class, particularly when we put rates into a global context. While the Fed has been pushing back against the timing of its first rate cut, the reality remains that the ECB has delivered its first cut, the Bank of Canada has delivered its first cut, and even the Swiss National Bank cut for a second time on Thursday, all of which served as a reminder that while the Fed might not actively be in rate-cutting mode at the moment, the type of policy divergence between the Fed and the rest of the world currently unfolding certainly isn't unheard of, but it doesn't tend to last for very long. The resulting bias in the Treasury market has decidedly favored dip buying, and even as the process of consolidation will most likely take a couple weeks to unfold, we're very comfortable with the notion that the peak for 10-year yields is in for 2024, and the next big move is going to be repricing lower with the 4% level as an obvious target in the 10-year space. We're certainly cognizant that the curve steepener, which many market participants have been anticipating would define 2024, has failed to come to fruition as of yet. We still think that it's too soon to begin scaling into that steepener, even if we do anticipate that 2-year yields have 75 to 100 basis points of downside between now and the end of the year. That will simply be investors responding to the Fed's beginning of what is assumed to be a lengthy rate-cutting cycle that brings policy rates back to neutral, with the prospects for either needing to cut further or more quickly in the event that the real economy slips into a recession next year.
The second quarter's economic data has largely fallen in line with the FOMC's objectives, with the prevailing narrative of moderating inflation, slowing consumption, and easing labor market conditions. This backdrop has left the apex of the first rate cut debate centered around the September 18th FOMC meeting, with the market implied pricing showing better than even odds of a rate cut at the end of Q3. That said, the Fed rhetoric in the wake of the June FOMC has stuck with the messaging that even 2 months of good inflation data isn't enough to entirely convince the committee that inflation is on a sustainable path to 2%.
And that's in keeping with what we've seen in terms of the price action. We have another 3 CPI prints between now and the September 18th FOMC meeting, and the market is trading it accordingly. 2-year yields are caught in a range, and anytime we back up anywhere close to 5%, we anticipate that there will be plenty of buying interest. It's also notable that while the last 24 months to a large extent has been all about inflation, we're now starting to see further signs of softening for the real economy, at least in terms of consumption, with a little more balance in the employment market. Now, this also has corresponded with Powell's attempt to remind the market that the Fed does have 2 mandates, one of which being employment, while the other is inflation. Now, in keeping with the theme of translating this into price action, the combination of disappointing retail sales, along with Fed rhetoric that suggests that the first live meeting will be in September, we have seen the 2s-10s curve invert further, now up against that negative 50 basis point level. Ultimately, we do still see the path of least resistance being a curve steepener, but that won't occur until we have convincing evidence that the Fed is truly ready to hike. Using the September timeline, presumably that inflection point will come in mid-September with the release of August CPI data, which we anticipate will provide a capstone of convincing evidence for the Fed to start cutting.
And to talk a little bit about the deepening inversion of 2s, 10s ahead of what will ultimately be that move steeper, accompanying the data that justifies the first cut, the flattening of the curve in some ways represents a degree of faith in what the Fed has communicated, and that there's still no urgency to bring rates lower. More inflation data is going to be needed for that to be justified. The labor market generally remains strong. And so the fact that we've seen this flattening in 2s, 10s back down to that negative 50 level take place in bullish fashion, with 10-year yields dropping back below 430, is a version of a policy error trade, and that investors are content to reach further out the yield curve to avoid the potential reinvestment risk associated with an overweight position in the front end of the curve. After all, with 2-year yields now down to roughly 470, and the Fed still saying cuts are not imminent, clearly at this stage it's looking more advantageous to lock in a 10-year yield at, call it 4.5%, than run the risk of the Fed overstaying its welcome at terminal, only to be forced to cut more dramatically, and then in turn bring rates lower more quickly and ultimately make reinvesting shorter-dated securities more challenging. And especially after May's retail sales data that was below expectations, with downward revisions to an already bad April read, the building sense of concern around the state of the consumer, even with the jobs market still strong in any historical context, is relevant in framing growth assumptions over the balance of this year, but also the medium term. A slower growth profile with the backdrop of front-end rates that are going to remain very elevated points to lower term premium further out the curve, and particularly as Treasury auction sizes remain unchanged for the time being, and given what we've seen in terms of sponsorship for long-end auctions recently, this adds to the case for lower yields across the curve, but it doesn't necessarily mean that that's going to be a move led by the 2-year sector, and so that means the steepening is on hold, at least for now.
And let us not forget that lower nominal Treasury yields are a Fed credibility trade. If one has confidence that Powell will keep monetary policy restrictive long enough to bring break-evens lower and re-anchor inflation expectations to that 2% number, then it follows intuitively that as break-evens compress, we should see nominal rates fall, even for the same level of real rates. Now layer into this the fact that real rates are likely to be on the decline in the event that Powell follows through with a rate cut, either in September or December, and the attractiveness of duration becomes all the more apparent. All of this being said, there's a clear theme among market participants at the moment, and that is investors are content to wait and see what happens on the core inflation side, wait and see what happens on the employment front, wait and see what happens in risk assets, all with the objective of determining the optimum point to begin scaling out the curve.
Ian, you touched on the performance of real rates and the interplay with break-evens, but it's also worth discussing the role that real rates are having in terms of the level of restriction of policy and the growth assumptions that are implicit with 10-year real yields that are still above 2%. To look back at any point in relatively recent history, say since the global financial crisis, real rates that high imply one of two things. Either outsized optimism on how the economy is going to perform over the next 10 years, and the likelihood of a slowdown, whether that is an official recession or not, but anything relatively close to zero in terms of real growth or even sub-zero obviously runs counter to this idea of real yields that are still above 2%. There's also the level of policy rates to consider, and the fact that with nominal rates at 5.5%, a 10-year real yield at 2% represents the degree of restriction that Powell wants to impart on the economy, and if in fact R star in inflation-adjusted terms is somewhere between 0 and 50 basis points, then that still means that real rates are well into restrictive territory, and in fact we could get 100 or 150 basis point move lower in real rates and still see rates operating as a drag on the economy. So longer term, that suggests that tips are probably still a bit cheap and real yields are probably still a bit high, if in fact the Fed is going to start bringing policy rates lower and growth is going to be a bit more subdued over the longer term. Now, the counterpoint to this, and something that's obviously been extremely topical within the Fed's rhetoric recently, is the question of where exactly R star is and just how restrictive monetary policy is, but especially as Fed speakers continue to discuss the idea of where neutral is in the post-pandemic economy, and as we look forward to the end of summer and the Kansas City Fed's Jackson Hole Symposium, a greater discussion on just how restrictive the Fed is actually being is probably going to be something to keep an eye out for, particularly within the more academic discussions around what exactly it is that's going on in the market.
And for Powell's part, he's been downplaying a lot of the discussions associated with exactly where R star is at the moment. I do think that framing R star as not a static number, but rather a function of the evolution of the economy follows intuitively and makes sense. After all, a lot of things did change because of the pandemic, and as the proverbial dust settles, we will, as an economy, most likely look back in hindsight and conclude that while 550 as the upper bound for Fed funds might not have been as restrictive in 2023 as some might have otherwise thought, 5% in 2025 will be.
And while policymakers have expressed a degree of openness to the potential for a higher R star, I think the more important takeaway is that Fed officials broadly believe that economic conditions are moving in the right direction, and the vast majority of the committee sees rate cuts being delivered at some point before the end of the year. Among the many Fed speakers we heard from this week, we heard Barkin say, "I think it's hard to know how much signal to take from the last half of last year, how much signal to take from the first quarter of this year, and how much signal to take from the most recent couple of weeks." And in keeping with the theme of a still elevated level of uncertainty about the inflation outlook, we heard Logan say we still need to see several more months of data to be convinced on the inflation front. And we heard Boston Fed President Collins say we shouldn't overreact to a month or two of promising news. And if one thing can be said about the Fed in the current environment, it isn't known to overreact to promising news.
And as if there wasn't enough for the market to consider in the current environment, we've also started to hear some discussion around funding pressures that are materializing with quarter end approaching next week. In the repo market, the quarter end date is trading right around 5.5%, or on top of where the standing repo facility is as well. And coming into this year, we were of the opinion that one of the things that could potentially go wrong, aside from the labor market, that would make the Fed be sooner to cut would be dislocations in the funding market or a spike in money market rates that triggered broader market dysfunction. Obviously, that has not materialized during the first half of the year, and frankly, given what we know about the Fed's reaction function to developments outside of the performance of the economy, aka Powell's market functioning support tools such as the Bank Term Funding Program, the Standing Repo Facility, the Reverse Repo Program, and the other central banking acronyms that have been deployed to make sure money markets continue to function well, even if we start to see things like repo begin to pick up more materially over important calendar dates, it's not clear that the first step from the Fed would be to deliver a cut to the Fed funds rate. After all, there's the rate on the standing repo facility that could be amended. There's tweaks to the RRP rate that could be delivered. And generally speaking, the fact that there's still almost $400 billion in money at the RRP, along with money market funds that have over $6 trillion in assets, which is the highest ever, points to a financial system that still has ample amounts of cash in the very front end of the curve. So while a pickup in repo over quarter end probably makes sense, it's not necessarily a cause for alarm. But as sources of volatility continue to pop up, with obviously French politics being the latest example, and what that's meant for some of the more popular leveraged trades in the Treasury market, anything that risks more significant volatility in the funding market is going to be a space to watch both into quarter end and beyond.
And it's also worth noting that the first French election is on the 30th of June, so right at the quarter end turn, and is undoubtedly contributing to, at least on the margin, some of the funding concerns. Thanks, Macron. In the week ahead, not only will investors have a full trading week, the macro outlook will also have the benefit of the May core PCE numbers. Expectations are for the Fed's favorite measure of core inflation to have printed at just 0.1% in the month of May. This will bring the year-over-year pace down to 2.6% from 2.8% in April. This will also mark the lowest core PCE print since March of 2021. That being said, we're somewhat skeptical about the degree to which Friday's core PCE will be a market event, in large part because the market has core CPI and core PPI in hand, and there's a well-traveled path of translating those two inflation measures into core PCE. Nonetheless, it's not a perfect science, and therefore there could be a surprise in either direction, although our base case remains for a print of 0.1. Let us not forget that within the same series, we'll have the personal spending numbers for the month of May. On the heels of two disappointing retail sales numbers, the forecast for a 0.3% gain in personal spending during May will be in focus, and any miss to the downside will likely translate into sharper price action than the opposite, i.e., an upside surprise. The Treasury Department will offer its last coupon auctions of the second quarter in the form of $69 billion 2 years, $70 billion 5 years, and $44 billion 7 years on Tuesday, Wednesday, and Thursday, respectively. Quarter-end and month-end influences should be particularly relevant, particularly given the timing of the French election cycle and the fact that the first week of July sees an early close on Wednesday, a full market closure for Independence Day on Thursday, and then non-farm payrolls are released on Friday, July 5th. So with a backdrop of such marquee incoming data, the quarter turn, and the general sense that the slip into a low volatility summer trading environment will be delayed, at least through the combination of payrolls and the June CPI release, we are anticipating a fairly choppy end to the second quarter, if nothing else. There's also a Treasury buyback on Wednesday afternoon, and as we get closer to the first round of the French election, we anticipate that both rhetoric as well as tradable headlines from the event will increase in both frequency as well as market impact. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the heat dome settles in and the mercury is on the rise, we find our outlook is very conditional, air conditional. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.